What's up, everybody? Erik here. I am back with Euan Sinclair. Welcome to the Outlier podcast, where we're going to be talking about trading. This is Euan's like half a dozenth time on the channel, so he knows that I am the resident lay person. He breaks things down for me pretty simplistically, hopefully, so that you guys can learn some stuff along the way. First off, Euan, welcome back.
Yeah, thanks for having me.
Pleasure chatting with you once again. We were literally just talking about what I think to be a pretty interesting concept, which is why I wanted to hit the record button here. But we were kind of talking about this idea of, time behind the screen and how that translates into profitability. And I kind of cut you off abruptly. I apologize for that, but it was really interesting stuff. So I was hoping I could re-engage your thought process there and have you share it with the broad audience.
Yeah, so I'll try and sort of go back to what we were actually talking about. There's this idea that people have that the more time they spend trading or the more effort they put into trading, so not even time, right? It's like, we all know smarter is better than longer, but they think that the more effort they put in, the more money they will make. And that's not unreasonable to think that, because that's true in most things in life. Like if you're a baker, you get paid to bake cakes. So the more cakes you make and the more time you spend making cakes, the more money you will make. But trading isn't like that. The payoffs are very heavily skewed to the first initial observation you make. So here's the simplest one that I can think of. Stocks go up. Okay, now that is the most well-documented fact in trading. Stocks go up. Over the long period, all the data we have in every country we have, that's like the closest thing to an unassailable law of nature. So once you know that, you go and buy some stocks, right? Buy and hold. That's your plan. It turns out beating buy and hold in any sort of way that we can judge someone's skill is astonishingly difficult. So timing the market seems to be very close to impossible. I'm not saying it's impossible, right? But the amount of effort you have to put in to do that, you might turn your Sharpe ratio from buy and hold from a half to like 0.55, maybe. And even if you're good at picking tops, the times you miss, the market will still be going up. So you're going against that inexorable tide that the buy and hold guy has on his side. It's really hard to beat that. Stock picking's not quite as difficult, but it's still astonishingly difficult. And you'll hear someone say, oh, look, I called this, I bought this. It's like, yeah, okay, but there've got to be some winners, there've got to be some losers, right? But if you look over time, look, the professionals, these guys are better than your average dude behind a screen at home, right? They just are. They don't show any ability to consistently beat the benchmarks, like none. Like Warren Buffett, who legitimately did for 3 decades, I think, he absolutely crushed it, right? His Sharpe ratio was less than 3/4. So that's the amount of skill you need to beat the very, very simple observation. And that happens in a lot of things, like with the variance premium, right? There's your observation. Options are usually overpriced. Well, if you come up with a really simple way to monetize that, just by, say, sell VXX, sell VIX futures, sell index options. Now, these are all slightly different, but they're all based on that same thing. And once you've done that, you versus me, who I'm going to arrogantly say I know more about this than you.
Unbelievable. Cannot believe that.
P&L is going to have very, very, very high correlation. Like once you're in the same trade as me, overall, all of the little details I put in, it's like, yeah, well, I mean, it just really doesn't matter. So it's I think people screw that up more than anything else. Because the one thing I guarantee you, if you trade more, you rack up more costs. That's guaranteed. But what isn't guaranteed is you trading more actually adding anything. So that was basically what I was going to say to you before we went on air.
Yeah. And I think it highlights an important point though, especially for a lot of the newer traders, because there is this, and I mean, I can pretty still well remember this. There's this function where you feel like, you have to grind more, you have to put more time in, you have to put more positions on in order to make more money. And then over time you kind of realize that's not so much the case. Now, how do you balance maintaining enough activity to diversify risk without being overactive?
I think most risk diversification, well, the most effective way of doing it is diversifying across positions rather than timing and actively trading one position. Because diversifying across positions doesn't really cost you much more. Like, it doesn't cost you more to buy 100 shares of one company and 100 shares of another company than it does to just buy 200 shares, right? So that is the best risk mitigator. And a lot of the other tweaks and stuff you do, you're reducing variance of P&L, right? So in the options world, the more you restrike, the more you rebalance. Yeah, you absolutely are maintaining exposure to the risk factor you want, but you're reducing variance. That's perfect. But you're also, again, racking up costs by doing it. And not just the cost of doing the trade, but if you're sitting there staring at your screen all day, you're essentially, your labor is going into that as well. And that's a pretty significant cost, right? Like if it's like me actively trading all day versus some guy who just does basically a buy and hold version of what I'm doing, the analogous thing to it, I've got to sort of somehow make up 40 hours worth of my time on top of the money he makes. I mean, that's very, very difficult to do. So I think it comes back as well that people see professional traders, and I don't mean, people who trade professionally. I mean real professional traders, right? Someone who works for Susquehanna, someone who works for Goldman, and people see them at work all day. But that's a very different thing. Like, it's a totally different game. It's like saying you're in the army, I'm in the army, right? Except that you're in special forces and I'm a cook. You're in the same industry, but comparing like to like is kind of, it's just silly.
Yeah. And you hit on something that I try to reiterate as much as I can, because I think this is something that retail traders really struggle with. And it's kind of the friction aspect, the cost of doing business. It's hidden from them in a lot of places now, right? Commissions are super low, upfront commissions. So
Right.
can you talk a little bit more about the friction side of trading? Because you talk about how big of an impact that has on profitability, but then a lot of retail traders that don't fully understand that picture, they'll say, well, shit, Robinhood has zero commission, so I guess I'm doing really great, I should hedge all the time.
Yeah, Robinhood does have zero commissions, but Robinhood makes money, and it's not just by selling ads, right? They're making money by basically passing your orders off to someone else, the payment for order flow situation, right? So they get paid to send their orders to Citadel, and Citadel gives you a shittier fill than I get by putting it in through IB. Now, IB charges me $1 per option if I go through as a retail person. I think that's right? I don't know. I don't trade.
I think it's like IB. Yeah, I think it's like 50, 60 cents now for most of the main platforms per option.
Okay, so you don't see that on Robinhood because you don't get that. But what you do get is a crappier fill from Citadel, and it's probably worse. Like, I would think that if you traded on Robinhood and someone else traded on IB doing exactly the same trades at exactly the same time, I think you'd probably do worse at the end of the year than you would on IB. Like, I'm pretty sure those costs are going to be higher, because name another industry in the world where the wholesale operator has higher costs than the retail operator. And if you're throwing shit through IB, you are slightly closer to wholesale than you are if you're throwing shit to Robinhood. And also, it's like most of these retail platforms try and get people in with the bells and whistles, right? So you'll have an app, you'll have a really nice way of measuring your risk and showing, you know, your P&L payoff under various scenarios and blah, 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 blah. None of that's worth shit. The thing you should use to improve your trading is none of that. It's just the lowest costs. Because all of that other stuff, is it worthless? No. But it's not worth paying the amount you're paying in higher costs. Like if you give me a really nice platform that has all that stuff and then a crappy one that doesn't, and they've got the same costs, well, obviously, right? But it doesn't. It's like how casinos give you free drinks. You know, and I mean, they seem great, right? You can have a nice whiskey that's a $12 drink. I mean, the casinos, they're not idiots. You think TD Ameritrade's making all that nice looking stuff and not charging you for it just because they like you?
I think you bring up another point that dovetails beautifully off of that, where I don't think retail traders fully understand the landscape of how brokers fit into this world. Meaning, I think a lot of them think, for example, like broker education. Really cool that a lot of brokers will provide education. But I think they don't understand some of the inherent incentives on the broker side in what they're presenting to retail traders. What's your perspective on the way that the broker and retail customer relationship operates? Because I think a common thought process towards that is retail traders think like, oh, we're friends. They're trying to do everything they can for me because they like me, not fully understanding what it actually is.
Yeah, it's I hadn't thought of it like that, but yeah, people think, oh, that education platform that sends me to this brokerage, they really want me to do well. So they think the broker is their friend, right? And then they think the market maker is their enemy. Whereas in actual fact, the broker is your friend in the way a drug dealer is your friend. Sure, he's going to be friendly, but he wants you to buy the damn drugs. And the option trade broker wants you to do all the options. You think it's a coincidence that a lot of these people are pushing you to do iron condors every day? You know how much money that racks up for the broker in commissions? So, and conversely, the market maker doesn't give a shit about any of you. The market maker doesn't think about retail at all. So, yeah, it's I mean, brokers want you to trade, and I think that's one of the problems where people are. This is one of the big deals with zero DTEs, right? The edges in zero DTEs are minuscule, but the costs are still the same. You're still paying, like, what do you say, 60 cents an option? So you can pay 60 cents an option for a 3-month option or one that's got 3 hours left. So the costs relative to your edge just become enormous. But the broker doesn't care. You're doing that every day. Just look at the numbers for him. And one of the problems, and this is professionals as well, costs are always small on any given day. Like your P&L just from doing the options might be plus or minus $5,000, and your cost might be $50. But that's $50 every single day. You make 5,000, give me $50. You lost 5, give me $50. I mean, it's like you're attaching an infinitely negative Sharpe ratio to a variable P&L. So people don't want to hear this, right? They want to think, how do I improve my trading? It's like, I do more research, I look at new indicators, all that kind of stuff. You improve your trading by reducing your costs. You get the cheapest possible service you can. You negotiate the best rates you can, and then you trade as little as you can to maintain the exposure to the risk factor you want. So if that means you're accepting more variance around it, that's probably what you should do. Variance isn't your enemy. I mean, variance, it's not fun, but it doesn't cost you money on average, but it costs you money to remove it.
Right. And the thing you highlighted earlier is something funny because I see this on Twitter a lot where people, they retail traders seem to like to make it like David versus Goliath, him versus, them kind of thing, where if you make money, that you're keeping it from the market maker. There's literally GIFs and memes about that exact thing. And I always just chuckle when I see those, because it's just, they're missing the broader relationship. But speaking of the market makers, I actually just did a video on this not too long ago, but it was a good question that came up on Reddit that I wanted to get your thoughts on, which is market makers. We know they're subject to order flow. They essentially are going to make markets as orders come in. But there's a lot of this conversation about like a max pain strike and then potential stock market manipulation, depending on if we're very close. I think at least that's the most efficacious variant of that I've seen. Whereas, some people will say, well, if max pain is 15 points away, if it's $100 product or whatever, they'll say, it's like the market maker's not moving at 15 points, man. Like, it's just the order flow is going to be what it is. But what are your thoughts on max pain? Let's say if it's $100 stock, max pain is at 101, and right now we're trading at 100.5.
Okay, so I've got to back up a bit. What the fuck does max pain mean?
Yeah. Okay.
And the fact that I have no idea about that, and I've been in the market making world for 30 years, tells you an awful lot about what market makers think about it. I legitimately don't know what that strike means. Is that like the amount of gamma exposure they've got and that kind of stuff?
It's where the highest notional value of open interest lives. So the theory then is that the market makers obviously would prefer for those options to expire worthless if they had a choice. Yep. So the idea is that if they're very close, that there would be some element of manipulation to attempt to get just over that hurdle. That's the idea.
Okay, so that's a real effect, without a doubt. And it's nothing to do with the market makers trying to do anything at all. What actually happens is the market makers, just through the nature of their dynamic hedging, if they're long, right? So if they're long, they want the market to move, right? They're long volatility, right? They want movement. But the thing is, if you're long and the market goes up, you sell stock. If it goes down, you buy stock. So the market makers' manipulation is almost always screwing themselves over. So it's when they're long that they'll get pinned to a strike, because the dynamic hedging is compressing things. And conversely, if they're short, they'll get driven away from the strike. So it's not manipulation, but if you want to think of it as someone getting systematically screwed over, it's the market makers who are getting screwed over. It's not retail. And market makers can't push things, with the exception of very, very small stuff. If you've got a stock with a, daily stock volume of, 100,000 shares, and there's a $5,000 lot option position that's out there somehow, yeah, that'll move the market. But if you take the S&P complex and you look at the total amount of trades that go through as hedging for option positions, it's less than 1% of the daily volume. I mean, no one's manipulating the S&P 500. I mean, that's like me standing at the dock and trying to push a battleship, right? It's just not going to move it. It's market makers. If there's manipulation going on, it's market makers getting pushed around by big customer flow. And it really is it's a secondary, tertiary effect. I think people like to talk about it because it removes the responsibility from them. But do you ever watch Mad Men?
Yeah.
Okay, so there's a thing where Don Draper is talking to Pete, and Pete's like going on about, I think this about you, I think this about you. And Don Draper looks at him in a kind of a blank way and says, I don't think about you at all. And that's how market makers feel about pushing the market round and stuff. I mean, they're too busy doing other shit. If you're market making stocks, you'll be market making options on 300 or 400 stocks. You don't have the time and the energy and the bandwidth to go around pushing something around because, I don't know, someone on Reddit bought 500 options. I mean, it's just not going to register. So, yeah.
I think you highlighted it beautifully, though, where the retail trader is looking for a boogeyman, right? Like they want something to remove their own shortfalls and to be able to blame something.
Yeah, and you'll definitely see situations where you identify the strike and then the market rushes towards it. I mean, of course you will, but it doesn't happen systematically, and it doesn't happen big enough to actually do anything with. I mean, you can't. Again, generally, so I know there's going to be someone out there now who's mad about the fact that I just said that because it's Reddit, right? So people are mad on Reddit all the time.
He was grumpy, yeah.
Yeah, it's like, what am I going to be pissed off about today? So, yeah, in general, it's just not really market makers aren't manipulating anything, with the exception of the VIX market makers on the expiration, where those guys are still screwing over the world.
Talk a little bit more about that.
VIX futures settle to the print of the VIX on the open on a given day. You can manipulate the print of the VIX by trading S&P options. So if you're trading, and particularly very far out of the money puts, so you can push that around a bit just by, for example, hitting all the bids or lifting all the offers. That's enough to shift the VIX settlement a bit. It's a big enough deal with the VIX where there was people were really complaining about it maybe 3 or 4 years ago and telling the CBOE they should fix it and blah, 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 blah. But they're not going to fix it. Because if you look where the big market makers are, they're the guys who are doing that. So they're not, you're not going to convince those firms. Well, I'm not going to mention them because I don't want them suing me. You're not going to convince those firms to go along with a restructuring of that. But you could easily fix it. You could have an averaging process over an hour or something. I mean, that used to be a really big deal in index futures as well. Like when I was trading in Germany, there were a couple of times when the settlement to say, like the curve, it should have been sloping up, right? September should have been under December. But there were a couple of times when I was there where the December future settlement price was above the December price. And it was higher than the index itself had ever traded. Because of the way they settled the index, it was like to the first certain number of trades of each stock. So they don't have to be synchronous. And it's just, yeah, manipulation like that happens because that's like an instantaneous thing that you can do with very small volumes if you do it right.
When you say very small volumes in that context, I still imagine like the VIX itself isn't like small. Obviously, neither is the S&P 500 products. So when you say like very small volumes, what is that? Because for a retail trader, it's probably still huge, but.
Oh, you're talking about multiple thousands of S&P options, the big ones. But yeah, you do the numbers. I mean, these guys aren't doing it randomly, right? They know that each point in the VIX is worth this amount to them. They know they can move the VIX by this amount by spending this amount on the options. Yeah, that is a thing.
And then for that kind of phenomenon to hold true, do you think, collusion between some of the different firms in order to move things more efficiently? Or is it just kind of each person kind of understanding that that's generally what people are going to try to do in their position anyways?
I doubt that there's actual real collusion because people, well, I was going to say people aren't stupid, but we've seen a couple of situations of collusion recently, right? In the metals market and in LIBOR. I mean, if you're dicking around with LIBOR, that's a pretty big deal. And these guys were, right? What are they using? Yeah. Snapchat or WhatsApp or something. But anyway, I don't think these firms would be doing that because it's not one or two traders doing it. It's like more of a team effort. There was a thing that I saw, I'm trying to think of it, maybe 3 or 4 years ago. I saw a way that you could sort of predict which way the VIX was going to get pushed on the settlement,
Literally my next question.
but I can't remember what that was.
Damn it.
And also, I mean, I don't know. That was a long time ago. I don't know if it's still true.
Yeah, because that actually seems like the kind of thing that would be right up your alley with some of the things that you talk about in terms of, people finding edge through observable phenomenon. But
Yeah, I guess the closest analogy would be market on close order imbalances, which is one of those things everyone thinks it's got to have some sort of predictive power, right? And people think first, if you know there's a big buy order, you can front run it or whatever. But it turns out by the time that's made public, you can't. There's not much in that anymore either. So sometimes just because these things look like they're front runnable or fadeable, I mean, doesn't mean they necessarily are. And I think, the order imbalance thing probably was, but it's just not really anymore by the look of it.
there's a lot of things that I've heard you talk about that seem to fall into that not anymore category, or is not as much, just meaning in terms of like what kind of edge can be extracted or what provides edge, I guess is the better way to phrase that. What's the 10 years from now look like? Do you think that a lot of the things that we do will continue to contract like that? Because even something like variance risk premiums, we know it exists, it's still there, it's been observable, and it probably will continue to be there, but it's definitely contracted a bit. Do you think that it'll get to the point where it's not worth the risk taken, or that there will be another alternative?
For that one, I doubt it, for two reasons. First, it's been around for as long as we've known about options. So at least 130 years we've known about this, right? So the fact that it's been low recently, although it wasn't in the first half of this year, you would have fucking killed it, right? So the fact that it might have been low, something's low for 2 years, but it's been big for 128 years. Statistically, that's not much in the way of evidence, right? And the other thing is there are just such sound sort of psychological reasons for it being there. If someone's taking risk away, they're going to pay for that, and, in options land, options are risk neutral. They don't care whether you're the buyer or the seller. They think you're only interested in expected value, but it's not like that.
When we're talking about the movement of variance risk premiums, what are some of the simpler ways that a less sophisticated retail trader can track that relationship?
Well, it's really easy to track what it has been. And there's lots of measures of it. There's no such thing as risk premium, right? It's a family of things.
Right.
So one of the ways you could do it is just keep track of the at the money volatility of, say, a constant tenor option. So like the S&P 30-day, and which you can legitimately do now to a day, right? The 30-day at the money volatility, and then see what the subsequent, it would be 21 trading days, realized volatility looked like. So you can do that. The problem with the risk premium is you don't actually see it contemporaneously. Because all I know today what the implied vol was. I'm not going to know what realized vol was for another month. So you're comparing things going forward with a particular observation now. So it's difficult to do that, and it's very difficult to predict it. It seems like it would be easy because, it's a mean reverting series. You would think it would be easy, and it's not impossible, but like I said, it's one of those things where it's really hard to beat the simple, naive observation that there's a risk premium, so I'm going to sell options every month and rebalance them. It's really tough. It's really hard to beat that by timing the market.
You bring up two things. The first one I'm going to linger on because it was the last thing you said. This is just another saying I hear a lot. This is more for like equities trading. I see it used, but I'm genuinely just curious in your thoughts on the saying that time in the market beats timing the market.
For most people over most time periods, that's unequivocally true. Timing the market the problem with it is even if you get the fluctuations right, you'll be out of the market or short the market enough times that you're going against that tide. I mean, think about it. The market is literally giving you 8% a year. So that's what you've got to beat by all of your little wiggling around. Furthermore, all of your little wiggling around, you got to pay tax on all those profits. And the more invested you are and the more often you're trading, the worse your tax situation is going to be, right? Because it's all going to be short term. And you're actually trading all the time. So there's trading costs involved. It's very difficult to beat the market by timing it. It's more possible to beat the market by picking stocks. I mean, again, not easy. You know, like Warren Buffett, like we were talking about before. Warren Buffett, who, you know, legitimately a legend. His Sharpe ratio was about 0.74. You know, and I've seen people on Twitter, Reddit, you know, whatever platform you like, who are like, well, I'm not going to do all that work to get a Sharpe ratio of 1. Well, you know, go and tell Warren Buffett that he's wasted his life, because getting a Sharpe ratio of 1, a real one, over a long period of time, I mean, that's going to put you in the Hall of Fame as a stock trader or as a long-term trader. So, I mean, it's just, I think people have wildly unrealistic expectations. You know, the people who are like, I just want to make 1% a day. Or even I want to make 1% a week. Really? That's nearly 60% a year. Can you do that? Well, sure, some years you will, absolutely. But on average, again, just get your calculator out and see what, you know, $10,000 compounded at 60% a year, see what you've got after 2 decades. You know, tell me if you think that's likely.
Well, the follow on to that is a lot of times when people say time in the market beats timing the market, they'll add a secondary metric. I've seen different versions of it, but typically it's like, you know, if you miss the 10 best days, then your return drops to whatever.
Right.
I'm always curious how to think about that, because to me, that also would indicate that there's a pretty significant reward if you can get decent at timing the market in intermittent timeframes. I think most of us acknowledge that timing the market in very short-term timeframes is near. Again, I don't like using absolutes. It just seems near impossible. It might be doable, but it seems very difficult. But what do you think about the capacity to time markets in more moderate timeframes? Because we do know a few things about markets in long run series.
I don't think that's particularly easy either. If you think back to the 2 biggest market crashy events of my life, well, certainly, you know, anyway, the 2008 crisis, right? When stocks absolutely cratered. I knew plenty of people who sold the bottom of that one. And these aren't like people who are, you know, idiots. These are like professionals who thought the market was going to zero. More importantly, COVID, right? The headlines from around COVID and all the sensible views on what would happen would have had the stock market absolutely crashing. The stock market had some of its best years after COVID. In 2021, the stock market was up 28%. You know, it's like all of your sort of, this is what's reasonable, would have pointed you in the wrong direction. And think of all the people who made a couple of famous calls back in the old days, you know, like someone who predicted the 87 crash. And then they've been predicting crashes ever since, right? Let's say you're an absolute legend and you predict a 10% crash. Did you also miss the 28% rally in 2021? Because that you've got to get a lot of 10% crashes right, i.e. make legendary calls a lot in order to make up for a couple of bad ones. You know, so maybe, but I'm not going to waste my time doing it. I got other things to do.
Yeah, I kind of see it in 2 different lights, because to me, it seems like if you can get okay at it, it definitely would pay well. But then I also look at, if you look at like a day trader's typical life, and again, I'm a pretty stark advocate against day trading being like the only thing somebody does. I think it's good to diversify across timeframes. But for a day trader, if you think about like a good day, they might take a point out of something on Monday, a point out of something on Tuesday, so on and so forth. And they might miss a couple days, they might be down a couple days. But then, I look at the aggregate performance for them. And a lot of times, if they had a good week, they might make 10 points, but the underlying might have moved up 15 or 20 points. So it's kind of like you're, cycling to catch these small things, even though the positive drift or, whatever the force was at the time led to this bigger move that you then didn't participate in. Do you think that there's a middle ground for people that are looking to time things where if your goal is not so much to top tick or bottom tick, but if your goal is to generally ride the positive drift of things, but then decrease your participation in drawdowns? Because I think that there's two ways most retail traders can do really well. One of them is make really good returns, if you can do that. But then the second is to avoid drawdowns, to not go down as much as the market, because then you obviously have a better launch pad for whenever you can resume the upside.
I'm not convinced that they're any easier. The way to avoid drawdowns, right, is deciding when the market's going to go down. And that seems to be a very difficult problem. Or you buy puts, which is almost always a bad bet because they're wildly overpriced, right? So I think they seem like different approaches, but I'm not sure they are. But I would take a little bit of issue with your first thing you were talking about, the market went up 20 points and you took 10 points out of it. I think that's legitimate if you aren't benchmarking against the market. So let's say you put all your retirement savings into, some mutual fund and you only look at it every quarter. Good idea, by the way, right? But every day you come in and you're just trying to ride the fluctuations in something and go home flat. I think that's legit. That's sort of how I treated Bitcoin or the crypto space in general, right? I wouldn't want to be in crypto. I have no interest in being invested in any of that garbage with any of those garbage people who do that garbage stuff. But as something that sort of just wiggles around, yeah, that seems fine. So I think it's legitimate as a day trader to benchmark yourself against cash. And if you're making 10 points a week on that basis, that's terrific. It's a different thing to long-term holdings. I don't want to say investing is different from trading because they're not. They're both exactly the same thing, but they're on very different time scales, the way we usually use those words. But, when someone says, I'm not a trader, I'm an investor, really, look up the definitions of what those things mean, right? It's exactly the same. Gambling as well, right? All of them, you're putting money at risk in an uncertain situation with the aim of making money. It's all the rest of it is sort of, I don't know, a lot of it's moralizing, I think. Being an investor, that makes you a good, sound human being. Being a trader, well, that makes you sort of a risk seeker, but you might be a superstar. And being a gambler, well, you're going to be, lying on the side of the road, drinking out of a bottle in a paper bag. But none of that's true, right? I know gamblers who've made millions, and I know plenty of investors who've lost money. So there you go.
Yeah, but then what random pedantic terminology could people fight about if, we don't nitpick terms?
Well, that's the thing, right? Nowadays people will never run out of things to be mad about.
That's fair.
Yeah,
that's totally fair. So this is another interesting paradox that I think is fun to talk about, which is a lot of what we're talking about here is looking at historic reference periods, observing something, and then making an assumption about what it's more likely to do in the future.
Right.
How do you balance the idea of using a historic reference period, but then tomorrow isn't necessarily today, or what isn't necessarily going to be what it was yesterday. Yet, if you look at like the properties of volatility, right? The easiest way to see what volatility is going to be tomorrow is take a peek at what it was today. It'll probably be close to that. But then we also know that volatility does have transition periods where it's going to move to another period to cluster. So it seems like those two things are at opposites, where there's a historic reference period that we then try to forecast off of, but then we're also saying you can't really trust this too much.
Okay, you watch baseball?
No, fucking hate it. Boring as shit.
But you are aware there is a game called baseball.
Very aware.
Right. And the best team, like ever, like might win 110 games. Right. So the best team, without a doubt, the best team is only going to win 2/3 of their games. So then you've got a really strong signal, but the noise is also very, very big. So it's clear that a team of Hall of Famers is better than a team of scrubs, but the amount of randomness in there is still very big. So that's the sort of thing about the signal and the noise with finance. You know, over time, you know, you come back to me in 50 years, the stock market will be higher, guaranteed. What's it going to do next week? I have no idea, you know, because we're looking at, well, on a daily level, right? And I was just looking at this today, so I know these numbers for a reason. I don't know every year. 2021, the market went up 27.5%. But the average daily volatility on a daily level was 0.8%, right? So the daily randomness is about 8 times as big as the daily drift. But the drift is the thing that we can predict. So there's always, what we don't know is always going to be way bigger than what we do know. So you look for these broad effects. Stocks go up. Carry is a good thing. Options are overpriced. Leveraged ETFs go down. These have all got a lot of data behind them. And they've also got compelling theoretical reasons for why they're true. Like, you can't just look at data and say, well, this is what it's been in the past. I think it's what's going forward. Because, well, there's got to be a reason too. And if you can't identify the reason, you're in a very unpleasant place, because you don't know when your edge is going to go away, because you don't really understand why your edge was there in the first place. If you're a high frequency trader, that's not a problem, right? You don't need reasons because you've got so much statistics. You know, you've got millions of data points for a day. But if you're an option trader, well, you know, the VIX has been around for what, 32 years? You know, that's not a lot of data on a daily time frame. And volatility realistically moves on more like a weekly or a monthly time frame. You don't know very much about the VIX. So just doing analysis on that isn't, you need a theoretical reason on top of that.
That's a really great way to think about that. Yeah, because it's something that I've always used more of a probabilistic explanation, but I think the part that you highlighted there, that's something that I definitely will kind of put in my pocket going forward, is the idea of identifying a reason, because I think that that does at least help us understand some of the pervasiveness. Whereas, like I said, for me, I typically would just look at a recent part of the series and then just think it's more likely to look like that. Now, that leads
to be fair, there are plenty of times when I do trades just on the statistics and I don't really know the reason. But I think you have to treat them very differently from ones where you do know the reason. You know, I mean, I'm not saying that I don't overtrade. I'm not saying I don't do stupid stuff on things that are marginal. Try and manage that tendency. But there are certainly times where I do trades just because something's always worked, rather than I know why it's always worked.
Right. It leads me to a follow-on question where we know volatility clusters, we know that it mean reverts. What are your thoughts on different ways traders can identify if it is likely to begin transitioning into a different spot?
The sort of the holy grail, right, is to predict when it goes from a low volatility to a high volatility state. That's really difficult because all of those transitions are driven by something different. Like volatility needs a catalyst in order for it to go up. It doesn't need a catalyst for it to stay low. That just means nothing's happening. Whereas when something happens, the something's always different. So if I knew how to do that, I would be very happy. But on the other hand, you can identify when spikes are likely to revert because we've got data on the average length of spikes, because it's difficult to predict that bit. But the decay process afterwards, I mean, that's basically what all of these Garch type models are modeling. They're modeling the speed of that mean reversion. So that's possible. I mean, that is what all the myriad thousands of versions of Garch do. But to be honest, you can kind of get a decent idea of just looking what it's been like in the past. Like when the VIX spikes to 40, when it comes back down through 40, how long did it take to get to 20? Not just the average, but what's the spread of results there? And just looking at what's happened in the past to give you a lot of context for how things are likely to come down. It's much easier to predict that relaxation point than the spike. And predicting the spike is probably one of those things I would put into it might be possible, but it also might not be a very good use of your time and energy. Just because something's possible doesn't mean it's economically sensible to do it.
Right. It seems to me what I like to do if I'm trading some sort of VIX product, looking at a more contemporary time frame, depending on the duration of whatever my thesis is. Actually, a trade that I recently did that you would hate is when the VIX dipped below 13, I established a long position in the VIX using options. So I bought further dated deep in the money calls. And it's what I did in that thesis was look at the performance of the VIX over the last 18 months, the periods that it dropped below 13, the duration below 13, the subsequent move outs. And I'm curious why you think that that is more difficult than the reversion back down if there's a way to wait timeframes, because we know VIX can stay low for a really long period of time. So
yeah, that's interesting. There are time series analysis by its very nature works on a constant time slice, right? So you say, look, what is the property of the daily VIX time series? What is more sensible in a way is to weight things in a different way. So you're weighting it by something else that indicates busyness. So maybe volume, maybe volatility, maybe you have a different way of slicing up your series. It's an interesting research avenue. So if someone is going to try and research that themselves, that's where I would start. It hasn't been studied to anywhere near the same degree as the time series stuff because the mathematics doesn't fit. It's not as easy to do. And like just coming up, if you want to measure the standard deviation of something, you need to have equally spaced things. So doing statistics on something that isn't a time series is much more intricate, and it's nowhere near as well studied. But that, I think, is a legitimate way of looking at things. I mean, I wouldn't tell you you're wrong for doing that. Typically, I think the problem with buying the VIX is however you do it, through futures, through options, through ETFs, the carry you're paying on that basis is such a huge thing to overcome. And that's typically larger at low levels. So you look back to 2016, 2017, I think a couple of the lowest vol years like ever. VXX decayed quite significantly. So typically those really low volatility periods are periods where that vol basis is really high. So I'm not saying you're wrong. And I think looking at it in that way is possibly interesting. But I haven't, it's not easy. Let's put it that way. And I haven't done it enough to say that you're wrong.
Fair. Another slightly...
I'm going to make a note of that. I might have a go at that at some point in some form.
It's been interesting, to be honest. And I tinker with different weightings, different weight periods, different weighting tools. But because to your point, like that kind of trade, it's not something I would put on for nearly a decade, what we saw during the bull market. But yeah, it has been interesting.
One of the ways that's surprisingly good, if you've been putting on short vol trades, and usually that's the way to go, right? And you've been losing money. Sometimes even though you're losing money, it's not because the VIX has spiked or anything, it's just path dependency and whatever, and there's a lot of luck involved and all that, but actual volatility is still where you think it should be. That sort of path-dependent noise seems to have some predictive power of vol spikes going forward. Not a lot, but one of my friends, James, often says you shouldn't sell vol when short vol is being a dick. And that's sort of what he means. It's like the profitability of vol trades tends to be correlated over time as well. So that's, again, an undeveloped research idea that might be worth looking at more.
Yeah. Switching gears slightly, I didn't see you talk about this stuff much in your book. So when I got this question for you on Reddit, I think it's a fair ask. It's completely different from like the more technical stuff we've been talking about. But essentially somebody was saying, looking for career advice from you for people that are looking to go from retail trading to the professional side. And I imagine you have an interesting perspective there. You already covered some color around that based on how different they are. But what are your thoughts on that?
Well, for a start, I'd emphasize again that they're often very different jobs. Like a retail traders have practically no edge over a professional who's trading the same thing, right? But if you're a professional and you're a dispersion trader, that's what you do. You come in every day and you do that. You don't get to decide, you know what, it's not working, I'm going to trade potato futures or whatever. You can't. You're part of a cog, you do your job, right? And you're told what your job is. Whereas if you're retail, you don't have to do that. You can legitimately bounce around. So if that's your style and you're like always finding the busy thing or the new little micro edge, which is doable, it's not easy, but people can do that. Because inefficiencies come along in various shapes and forms. Like in crypto, there was all that yield stuff that worked really well for a while and stuff like that. So you can't do that as a pro. So they are different jobs. In terms of making that transition, I'm not really very useful. I was going to say anymore, but probably ever. We never hire, well, or hired, depending on what firm you're talking to. We never hired people from outside the core group. Oh, they would either be professional traders who are coming from another firm or people straight out of college. So you come to me and say, I've got this, and track record. It's a pretty heavy reach for the firms I was at. But again, the firms I was at are just one little bit of the ecosystem. So you're probably better off trying to go to a hedge fund, I would think. I think they're probably less likely to be stuck into that. We go to We go to these 10 colleges every year and interview students and hire the best ones. But it's a tough transition. And again, it's sort of like, you know, the army thing, right? Maybe you're the best MMA fighter in the world, but that doesn't mean the army doesn't want people who can fight, right? The army wants soldiers. It's a different job. Seems the same, but it really isn't.
Yeah, can you talk a little bit more about the hedge fund angle? Because that was actually my original thought too, especially because I think one of the things retail traders don't fully understand is that, at least maybe I don't even understand either, but it seems like from what I've come across, that most of the time those kind of institutions are looking for math minds anyways, like just like really smart people, PhD types. Not to say that you can't break in otherwise, but it's not necessarily, you know, if somebody tries to go work at a firm and you tell them like, oh, I've been a retail trader for 10 years, like they're not going to give a fuck about that. That's my guess.
Well, again, that would depend on the firm a lot. The thing about hedge funds is it's such a broad category, and there will be hedge funds that trade very much like what you think a retail trader trades like. The problem with it is finding those hedge funds. Whereas, like, if you're looking at Citadel or AQR, yeah, they're not going to take some retail trader either. It's not so much they want math minds. That's sort of that's not really to the degree you might think. Some firms do, but a lot of firms don't. And I mean, certainly the kind of trading I've sort of been around, the best traders are certainly not the ones who are the most mathematical.
Sure.
Although having said that, when I say not mathematical, I mean engineering degree from Cornell or something. So it's still pretty mathematical, but it's not, I wouldn't consider them math people. But yeah, the problem with breaking into the hedge fund world is it's just so fractured. I mean, that's more of a networking problem. I don't really know how you do that.
What do you think the future for kind of more of the quant firms will look like 10 years from now?
Well, it's probably just going to be evolution of what's going on now, right? I mean, anything that can be computerized gets computerized. So the where that changes is the power of computers. Like, you know, 20 years ago, you just didn't have the computing power to do what they're doing now. But computers haven't really changed in their nature yet. They've just become more powerful versions of what they were 20 years ago. But we're seeing now with the whole AI thing, incidentally, if you don't pay 20 bucks a month for GPT Plus, you're insane. It's like the best 20 bucks I've ever spent. I mean, it's better than an intern by a lot. So that kind of thing, that's going to get incorporated into trading much more. And I know there have been hedge funds for a long time who say we've used AI and blah, 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 and they really didn't. Because up until recently, these guys who wrote GPT Plus are the best there is. You know, some random dude at a hedge fund is not that guy. But that sort of level of AI power is definitely going to change things. So it'll be the same as it's been. There'll be fewer traders in 10 years because the good traders will be able to, their skills will get leveraged over a wider universe. And the sort of the junior trader bit is going to keep getting more and more automated out of existence. But that's the way it's been going forever. You know, when I started, if you were trading stock options, you'd stand in the stock option pit and trade maybe options on 2 things, or maybe 3. Whereas now, you know, you'd probably be trading options on 300 or 400 stocks. So there are fewer traders, but each trader is trading more stuff. So I see that that's probably the evolutionary route that will continue to go down. It won't affect retail because you can still do all the stuff you do, but it will lower the cost structure on the professional side, which actually should help retail, right? It does get passed down eventually. You know, no one's paying 50 bucks a round turn for futures anymore.
Right. And same question, but for hedge funds.
Again, hedge funds are difficult because they're such a broad thing. I mean, AQR is a quant firm. You know, they're very quantitatively driven. They will be leveraging this computing power more and more. But if you're a macro guy, I mean, it's a totally different game. So I don't know. I mean, maybe it will be such a big change that those macro guys will actually be able to make some money.
Not even gonna lie, that was gonna be my next question is, do you think that it will increase the efficacy of macro specifically? Because one of the things I noticed from like any of the macro community, and again, this is just a personal anecdote from my own small purview, but it seems like a lot of those motherfuckers guess at a lot of fucking things and just keep guessing. And sooner or later, something's right. But if you look at like the actual percent accuracy, it seems so damn low.
Well, you see, I know you don't know about baseball, but you probably watch some sports stuff, you know, NFL pre-games or something, right? And you see these guys who legitimately know an awful lot about football, right? I mean, maybe they're not geniuses, but they've been in the game, they know the game. They can't pick winners. I mean, I see macro as like sports punditry for dorks. I mean, it's the same kind of thing. They're always looking to tell a story. And there might be, in the same way with sports gambling, where there are patterns, there's data, you can look at stuff, you can do stuff. People make money doing that stuff. Maybe that's where macro goes. Stop talking about bullshit stories about what you think will happen and actually do data analysis of what happens when this happens and so forth. One of the problems with macro is that all the situations are different, right? I mean, the war in Ukraine, totally different situation from the war in Palestine. Like, they're both wars. People are getting killed on both situations, but in practically, you know, the dissimilarities between them are so much greater than the similarities. So maybe AI will be able to start sort of passing that kind of stuff together. Maybe.
Why do you say maybe? To me, it seems like it would be pretty fair. I don't think it'll be, you know, like predictive in any capacity, but I think it probably could create some sort of like multi-point analysis between different things and to decide if something is more similar or more dissimilar. And then maybe you can make a hypothesis off of that, or do you think it's too far of a reach?
No, I mean, I think you could do something like a cluster analysis.
Right.
You know, where it's like they've done interesting stuff like that for sports as well. Like, right, with basketball, once you do a cluster analysis of the commonalities between different players, it turns out there aren't 5 positions. You know, there's more like 11 positions. It's just you don't always have them all at the same time. You could probably do that kind of thing, whether it's, so you could in that case say, I don't know, the war in Palestine is much more similar to the war in Northern Ireland than it is to the war in Ukraine, right? It's a guerrilla thing in an urban environment. There aren't tanks driving around and stuff and jet fighters. Maybe you could do that. That I know you can do, right? But whether that's predictive or not, I don't know.
Got it. Yeah.
I mean, there's a lot of things that are descriptive without being predictive.
I think that's one of the things I find so curious about that stuff is that I feel like what we see just in humanity on an annual basis is almost something we've seen some permutation of before, but it's always the confluence of all of those different permutations that create such a different landscape at that given point in time. That's why I'm curious if AI will be able to kind of decipher all of those variables more successfully than the human mind.
I think it will do better, but I don't know. There's just everything. They're all so complicated in different ways, right? It's like every president in the last 50 years at least has tried to solve the Middle East, right? Why haven't they? There's no solution. There's no, if there was an easy solution, then, you know, Gerald Ford would have done it or something. It's like, there's no, there's just no simple way to do this. And even when the wars stop, often people don't really know why that happened. Like the Northern Ireland thing just kind of stopped. And then they did all the negotiation and stuff, but it wasn't the negotiation that stopped it. It just kind of petered out on its own. And then everyone was sort of looking around for why did that end, kind of thing. So yeah, it's always just complicated. It's difficult. Like World War One, right? None of the people who got involved in World War One really wanted to get involved in it. It just sort of started happening and everyone found themselves all pulled into it. So, and that was like, second worst war ever, right? And it was sort of something that the world was sort of at that breaking point, but, some archduke getting shot. I mean, realistically, who gave a crap about that? That wasn't worth, how many 20 million people dying or something. I don't even know how many people died in World War One. A lot.
Actually, a good question. I'll find out right now. I'm curious. What's your guess?
Just combatant casualties, 20 million.
That's actually a really insanely good guess. So total military and civilian casualties was 40 million. Wow. 20 million deaths, right on. 21 million wounded. The total number of deaths includes 9.7 million military personnel and 10 million civilians.
Wow.
So you are, yeah.
Well, you read about the battles, right? And like the number of people killed on the first day of the Somme, it was like the size of a fairly large city. And now it's like a terrible war, right? I mean, we're talking now thousands of people. But, it's like 300,000 or 400,000 people died in the first 6 hours. And like, it's incomprehensible. It literally is incomprehensible. You just can't imagine that, right? There was an entire generation of European men who just was missing.
Vanished. Yeah. Yeah. That's actually, this poster right here is of the Marines at Belleau Wood. And like the whole poster is there's, Marines and Germans in gas masks. And one of them stabbing one of them with a fucking bayonet, one of them shooting them with a pit, and they were just in mustard gas. So to your point, and that's still relatively recent, right? Belleau Wood's not World War One. So it's fascinating seeing the evolution of warfare in that way.
Yeah, it's I imagine it's got worse in a lot of regards, but it certainly got better in a lot of regards as well.
Healthcare, like the ability to treat people, is massive. That's why we actually see battlefield casualties going down so massively. But
we see a lot more amputees coming back now, right? Because again, the survivability is so much greater.
Yeah. To wrap us up, I have one more question. Looking into the end of the year, not predicting anything, but I'm curious, is there anything that you are looking forward to seeing how it plays out into the end of the year? Or are you just kind of going along business as usual?
I think in terms of market news, it's kind of continuation of what it's been. It's like all eyes on the Fed. The next earnings cycle is going to be, I think, pretty important, because clearly we've got a fairly bearish sort of general attitude right now. I mean, bonds have gone down a lot. Stocks have gone down a lot. Gold's gone up. Tesla's earnings were terrible. But it's sort of, I think this earnings cycle is going to be relatively important for driving that narrative going forward. If enough of the big companies make money, people will suddenly be like, oh, well, maybe, even in this interest rate environment, maybe things are not as bad as we thought.
What did you think of the banks that started reporting already? Because I was actually surprised at how well they're doing writ large.
Banks are tricky. Financials are always tricky because it's sort of what they're doing, part of their business. You don't really know what they're betting on and you have to actually go through what they're doing. So like banks can do really well in a really bad period. Like typically retail banks do better at high interest rate environments, right? Well, high-ish interest rate. You don't want 20%, but you don't want 0 either. So financials are always tricky in that regard. I'm not sure they're particularly good bellwether for the rest of stuff. But once the techs start hitting more, I mean, we've already seen a few, right? But once they start coming online more, we might get to something like NVIDIA again. That'll shake things up.
Yeah, because I was actually, I do a YouTube live session with the community on Mondays, and we were looking at the Wells Fargo release out of curiosity. I like looking at banks for that exact reason, because if you go through their documents, you can kind of see how they're making, how they're losing money. And what I thought was interesting about it is that exactly, I mean, you already know this, but they're making good money in a lot of different methods. But then when you look at the customer facing side of business, it's suffering like pretty good, and you can see it. Mortgage rates, originations, as you could tell, they're down like massively. Auto loan originations down massively.
But
So
the edge on that stuff's up a lot.
Right.
Because, you know, they're charging now for auto loans, what, like 7% in some cases, right? But what are you getting paid out on your bank account? You know, that spread's now enormous, right? I mean,
Right.
people are still getting paid like 1% for bank accounts. So having like a 6% credit spread there is huge.
Right. Yeah, it's interesting to me to just kind of see the behavior of the customer side, right? Kind of continue building out what at least what that landscape looks for them, because this is, I know that I said I was wrapping up, but you just jogged my mind on one other thing. If you have a minute, I'm really curious your thoughts. That again, I know that you're not an economist, but I know that you watch markets, you know, way more than I do. But I've been surprised at how strong employment has held. It has the performance of employment struck you as any kind of way?
Yeah, I actually don't pay any attention to stuff like that. Like I'm always kind of shocked when like some big number like CPI comes out and I'm like, why'd the market move so much? You know, 7:30. Huh. Oh, someone points it out to me. Because I think things like that, it's like I care what the market did. I don't really care why it did it for that kind of stuff. Because I don't have any way of predicting what the market's going to do in advance. So I just don't really pay attention to it.
Fair.
I think one of the things, though, on a sort of societal level with employment, it matters much more now what kind of jobs are being created, because we're seeing a lot of shitty jobs coming around, you know, jobs paid at minimum wage, jobs paid where you're on like contracts essentially that last a day. So I don't think it's as predictive of the broad market. The headline number would have been as it was, say, 20 or 30 years ago, when jobs involved working for a company where you had like a whole bunch of sort of contractual protections and you got a certain, you know, standardized benefit package across companies and stuff. That just doesn't really happen to the same degree anymore. So I'm not sure. That number to me seems like something that we're going to have to kind of sort of reevaluate how we measure it. And I know you can break it all down, right? But the headline number doesn't.
Right. Yeah, and it's funny you say that, because I actually fall very much into the same camp, where when I look at unemployment and stuff like that, I kind of have like two different parts of my brain when it comes to markets. Some of it is like, what can I trade? And then I do have the other side is just markets, economy. I find this stuff interesting. I really do. I find it very curious. And I know we've talked about this before. You think I'm fucking absurd for having that, and you don't necessarily share it. But anyways, yeah.
I mean, there are a lot of people who find things interesting. People like fishing, you know.
Love fishing.
Just because other people like to do something, I'm not going to say that it's impossible that you like it. But on the other hand, I mean, to me, fishing and reading the economic news are right up there in terms of why I just cannot see why someone would find either of those things interesting.
Yeah, I think it's fair. Well, Euan, I know it's a little bit later on a Friday for you, so we'll get you out the door. But I love talking with you. It really, you have a very interesting perspective on things. And as always, genuinely appreciate you taking some time to share what you know with at least my community. They always look forward to whenever I'm chatting with you. So sincerely, thank you for taking the time to hang out for a bit.
No problem. I can go and watch the end of the All Blacks game.
Perfect. Well, I'm sure we'll be in touch soon, but enjoy the rest of your game.
Thanks. You too.